Hello, everyone, and welcome to today's webinar brought to you by Tax Connects. Today, we're going to dive into sales tax hot topics, and we hope that you are as excited about talking about these hot topics as we are. My name is Liz Brigson. It's a pleasure to be your host, and it's great to be here with my friends from Tax Connects. There's a couple things I'd like to point out to help you get the most out of the webinar, and just a couple things. So you can utilize the GoToWebinar questions panes to chat with us, ask your questions, share your experiences or your feedback. And if you want to say hi and let us know where you're joining from, we would love to give you a warm welcome. So say hi to Lorette in Massachusetts. Kim says hello, and we'll keep our eye on that questions box as more of you write in to say hi and let us know how your late August season is going. You can download the handouts from the GoToWebinar control panel. This webinar is 1 hour. We'll launch 4 polling questions, and as long as you remain logged in for 50 minutes and respond to at least 3 of the 4 polling questions, you'll qualify for your CPE credit, and you can access your CPE certificate from your Encorsa dashboard. If you have questions about CPE after the webinar, feel free to reach out to us at support@encorsa.com. I'm on LinkedIn. I would love to connect with you on LinkedIn and highly recommend that you follow the Tax Connects team as well. Moving on to the next slide, it's my pleasure to welcome back Jeff Meggs, who's a partner with Tax Connects, and Brian Greer, who is the Chief Revenue Officer. Jeff and Brian have been working together for over 20 years. They have a wealth of knowledge in the sales and use tax space. So you are in excellent hands over this next hour. I'm going to turn things over to you, Brian, and take it away. Thanks for being here.
Yeah, sounds great. Thanks, Liz. Yes, this is Brian Greer. Welcome, everyone. I think Liz may have mentioned this about submitting your questions during the presentation, so feel free to submit those as we go along. Jeff and I will probably take some of those during the presentation, and then we'll have some time at the end as well to hit some of those at the end. In terms of an overall agenda, as Liz mentioned, we're really trying to talk about some of the current trends and hot topics from a sales tax perspective. You see some of these outlined here, but there's obviously some major changes a few years back from an economic nexus perspective, but I think what we're going to talk about today are more recent within the last, I'd say, 9 to 12 months. Some of the changes that we've seen from a sales tax perspective. So without further ado, I think we have a polling question, Liz, and then I'll give kind of a quick background on Tax Connects as the audience answers this first polling question.
That sounds great. The first polling question's up on the screen. When you are thinking about sales tax, what is your biggest concern? So go ahead and click in your answer, and back to you, Brian.
Yeah, thanks for that. And if you're not familiar with our organization, I'm sure we have a few people that have been with us in the past, but just kind of a quick perspective on Tax Connects. We're really a professional services firm focused very specifically in the world of sales tax. And what does that mean? We really have 2 different practice areas here. One that Jeff heads up is our consulting and advisory practice. So we get clients, or I should say prospects, that come to us with just fairly general questions about sales tax. Where do I have nexus, and where am I supposed to collect sales tax, and do I have exposure? Basically, what do I need to do from a sales tax perspective to be compliant to my business? So that's a portion of our organization. The second practice area is a compliance outsourcing service. So for those businesses that have a multi-state sales tax collection and remittance obligation, we essentially plug in as an outsourced sales tax department and resource for them to help them manage that administrative compliance process of preparing and filing the returns, remitting payments to the jurisdictions, and so forth. So that's kind of a quick sketch of who we are. Liz, I don't have the audience view pulled up myself, so are you able to show what the responses were to the question or to the polling question, and then we can get started?
Yes, yeah, we're ready to close that polling question. Thank you for that overview. That was an excellent overview, really helpful. And then the responses here, the first one is keeping up with the changing nexus rules in each state, followed by understanding taxability of products and services, being audited, and then those ongoing filings. So thank you everyone for responding, and we're back to your slides.
Yeah, that's perfect in terms of, in our first couple of topics, the first one being related to Nexus, and we have some taxability discussion a little bit later. So I'll go ahead and turn this first piece over to Jeff.
Thanks, Brian. Thanks, Liz. And for those in attendance today, I apologize in advance for the scratchy throat. Just getting over a little something here, but try to make it through. As Brian said, today's discussion is going to be more or less some sort of new updates, things that have been sort of brewing, maybe brewing today, and maybe we can expect in the future. But hopefully these are things that at least some of you will have experienced. And I think the overall perspective I would have about today's presentation is it's really positive. It's a lot of positive information, a lot of new good news, rather than delivering a lot of bad news, which is what I'm accustomed to doing. So hopefully you'll feel that as we go through. There's a few pieces here that may not feel as warm. But the first slide here, I wanted to talk a little bit about economic nexus, some changes that have kind of come through the pipe over the last 12 months or so. And just a quick primer, the economic nexus standard for sales tax purposes did not really become a thing until mid-2018. And it's old news now. It's hard to believe we're 5 years now past the court case where the South Dakota Department of Revenue asserted nexus against Wayfair on an economic basis, basically saying if you have more than $100,000 in revenue and over 200 transactions in our state during a 12-month period, you have established nexus for sales tax purposes. Prior to that 2018 court case, the Wayfair case as we like to call it, we were primarily focused on a physical presence test, meaning you had to have some level of physical activity within a state before a state could impose its taxing authority on you. And that could be the obvious, having an office in the state, having employees in the state, could be having inventory in the state, and it could be having temporary availability into the state. It could be through employees or agents that are traveling into the state to solicit on your behalf, or there could be some services you're provisioning to a customer and you're leveraging a third-party contractor located within the state, or a third-party contractor that has to enter the state to perform said service. So those physical presence tests were long-standing sort of standards for our nexus determination for sales tax purposes. They haven't gone away. They still are here and in full force, but we have layered upon that the economic nexus standard. Now, as I said, South Dakota introduced their next economic nexus standard as a $100,000 threshold or 200 or more transactions within a given 12-month period or calendar year. I would tell you that the general sort of rule of thumb is to think about it as a $100,000 threshold across all the states. It's not true that all the states have the same nexus standard from an economic perspective. There are variables out there. For example, Texas and California, they both have a $500,000 threshold. Mississippi and Alabama have a $250,000 threshold. But what I like for our clients to think about is whenever you hit that $100,000 amount in any given state, it's time to just take a break and ask the question, have I triggered nexus for sales tax purposes? And there's other nuances within those thresholds that are worth evaluating when you get to that spot. But in any case, that's sort of the key. Now, in terms of updates, things that I think are relevant for today's discussion, Louisiana and South Dakota haven't started all this mess, by the way, but the Louisiana and South Dakota Departments of Revenue have now repealed their 200 transaction threshold. So it's only now in those two states a $100,000 threshold. No longer will they apply a 200 transaction threshold. That's a welcomed change. We have seen other states already making that change, and and we expect more will make that change as time goes on. Hopefully, the eventuality will be that transaction thresholds are not part of the equation. At the end of the day, really, this is about materiality. And, the $100,000 threshold is a seemingly safe place or spot to start. Somebody selling 200 boxes of Q-tips, let's call it, for $2 each is not where the states want to be in terms of trying to enforce or assert nexus. So I think that's sort of the idea that I think all the states are coming warm to, and we'll see some changes in other states in that regard. The only other highlight we wanted to kind of point out was that Missouri was late to the game in some ways. Missouri legislated an economic nexus standard a few years ago, but it didn't actually go into effect until January 1 of this year. So January 1, 2023 forward, you now have to evaluate your prior period activities, and if you meet that $100,000 transaction or $100,000 threshold, you'll need to evaluate whether nexus exists or not.
Yeah, and Jeff, to kind of echo what you said in terms of the welcome change with the repeal of the transaction count. In the past, and it still exists in some states, but you get a business that's just in a tricky spot with, I've got Nexus, but I only have $5,000 of sales activity. What do I do? They're exposed in those states, but the materiality just isn't worth it in a lot of scenarios. So definitely a good thing to see those states repeal the transaction counts. And to Jeff's point, we're going to see, I think, more of that as we move forward. Moving into the next topic on this slide in terms of Colorado, Colorado is one of these states that has home rule jurisdictions that, where individual local jurisdictions have the ability to set their own sales tax rules. So as we kind of think about nexus and think about these local jurisdictions, how does that economic nexus, at the state level, for example, in Colorado, how does that apply or affect these home rule jurisdictions?
Yeah, it's a good point, and I'll start and talk about a couple of different states here and lead up to Colorado. Alaska is a state that does not have a state level sales tax, so we tend to forget about it in terms of sales and use tax. However, there are a number of cities within Alaska that do have, as Brian described, a home rule taxing authority, city level taxing administrators who have established ordinances that require sales tax to be collected, charged, and reported and remitted on certain transactions. So the question became, how would those cities impose any sort of economic nexus standard as part of this Wayfair decision? And what Alaska did, the cities came together to form a coalition, essentially, that represented all of the cities together and said, if you have $100,000 in sales into the state of Alaska during a 12-month period, you are going to trigger nexus in each and every one of those home rule cities in Alaska. So despite the fact that the state doesn't have a sales tax, we do have to consider Alaska when we're thinking about sales and use taxes at this point. A couple of other states that have similar city level or home rule jurisdictions would be Louisiana and Alabama. And what those states took on when we established the economic nexus threshold was something similar to what we hear about in Alaska. So if you exceed the threshold at the state level, you're also going to automatically exceed the threshold at each of the individual home rule cities, or in the case of Louisiana, the parishes. But what those two states did was to create some advantageous ways for smaller retailers who had eclipsed that threshold. In Alabama, as I mentioned earlier, is 250,000. But the states afforded them some simpler guidelines and simpler rules for both charging the tax and remitting the tax. Alabama instituted a flat rate, so that you didn't have to try to figure out all the different state and local rates that applied. Louisiana kind of started out on that level, and then they kind of backpedaled, which kind of irritated a lot of people, including us. So Louisiana went down this pathway of this sort of set rate where you didn't have to deal with each of the parishes and their specific rates. But a few years later, after instituting that, they came back and said, no, we're going to require that you charge both the state and the local applicable rate for each of the individual parishes. The only good thing I think that came out of Louisiana was they did establish more of a centralized, consolidated filing option, and that has served the community well. And lastly, Colorado. Colorado is a pretty unique state. They're an aggressive state. They were very early in the sort of sandbox of trying to establish an economic nexus standard. They were doing things along this line in 2010, 2011, requiring retailers who met a certain dollar amount in sales into the state to either register for sales tax purposes, or they had to report to the state all of their sales activity in detail with customer names and addresses. So in essence, they forced everybody's hand. But Colorado, again, following in the footsteps of what we saw in Louisiana and Alabama, they instituted the similar sort of guideline or threshold. At the state level, if you have $100,000 or more in sales, then you will trigger Nexus for the home rule cities, each and every one of them. There's about 73 of them in the state of Colorado. Colorado also at the same time tried to do something similar to Louisiana, and they built sort of a centralized filing portal so that you didn't have to report, file, and pay into each of the different cities. The problem with their portal, there were numerous issues. It was not intuitive. It still required specific registrations with each of the specific cities, kind of outside the portal. There were just a number of challenges, and there continue to be a number of challenges that make the portal not very user-friendly. So as Brian described our business model, we file hundreds, if not thousands of returns probably in the state of Colorado today. And we are involved in using their portal, SUTS is what they call it, Sales and Use Tax System. And we have found it to be not very user-friendly ourselves. So there's validity that we've kind of seen proven out. More recently, the state has come out and said, look, this has got to get fixed. It's inexcusable, and they didn't say that verbatim in this sort of administrative directive, but they basically said, look, you guys have to improve this system. It's got to work for the taxpayers and be easier to use and more user-friendly. So they are mandated to fix or exercise improvements against this process no later than January of 2025. We shall see. Colorado has a long history of making life miserable for us on the compliance side as taxpayers. I don't say that there's malicious intent on their part. I just don't think they take into consideration the multi-state requirements that a lot of taxpayers have in the way of sales tax compliance, and I don't think they give any grace or enough grace for those sort of scenarios where companies are just trying to make ends meet in a compliance fashion.
Yeah, and some of the more specific challenges that we've seen with that sales and use tax system, it's interesting that the name SUTS, one of the issues is if you have use tax to report, you can't report use tax at the home rule jurisdiction level on the centralized sales and use tax system. So if you've got use tax, you got to file an individual return at the home rule jurisdiction level. Additionally, not all 73 of those HRCs participate on the sales and use tax system. I think the numbers are dwindling, and I don't think that's going to be an issue long term. But there's, as Jeff said, there's just some major challenges and flaws, and hopefully that'll get better over time for us all.
So, for the most part, that'll conclude our Nexus discussion for the day. But Nexus is sort of that baseline that always comes up as we're talking about any aspect of sales tax, just because it's so critical. It's sort of the first yes or no answer And if the answer is no, I don't need to worry about anything else. If the answer is yes, I have Nexus, I then have to consider other factors. But let's talk about marketplace facilitators and some ancillary situations that are a little bit Nexus related in this regard. We have, I'll first start with a little bit of a story. The state of Illinois was auditing one of our clients, a very large multi-state retailer, probably a name brand that most of you would recognize. And they asserted that our client had a responsibility for charging and collecting local tax within the state of Illinois. Our client was, and this is allowable, by the way, but if you are a vendor that has Nexus in Illinois and you're shipping product from a point outside the state of Illinois to a point inside the state of Illinois, your requirement is only to charge the state level 6.25% tax. You don't have to charge the local tax in those scenarios. So our client had been operating under that premise for quite a number of years, never had a problem. Well, this particular auditor wanted to assert that we had a responsibility for charging local tax. And the way he got to that place was he asked where was our inventory located and where was inventory being shipped from. And our client's database had data that could tell you from which warehouse product was shipped. So we knew there was product being shipped from Illinois locations. But it so happened that the only product shipped out of those Illinois locations were locations that were owned, managed, and facilitated by Marketplace. In this case, it was Amazon. The auditors stayed on this track, insisting that we still had a responsibility. He was setting up a very large assessment against our client, but there was very specific language within the statutes that afforded us the argument that pushed back on that pretty effectively. So, in 1/121, as we cited here in the presentation, Illinois laid that out pretty specifically and gave protection to those instances where a marketplace facilitator maintained inventory as a FOB type partner with a seller. The state of Pennsylvania kind of followed suit, and in late 2022 instituted similar language that just directed Nexus discussions not to include marketplace facilitator inventories. Now that's a different sort of scenario. There's not really the local rate issue in Pennsylvania. So all Pennsylvania is really addressing with that ruling is physical nexus. They're basically saying that just by way of having inventory in a marketplace facilitator warehouse located in Pennsylvania, you don't necessarily have physical presence or nexus for sales tax purposes. I think as the Wayfair decision kind of evolves and everybody gets kind of accustomed to it, I don't know that we'll see a whole lot of states come out with these regulations or rules or directives. I just think that there's going to be an acceptance level at the state level that they're not going to pressure companies that are only having nexus because of that inventory. And again, it comes back to a materiality issue. If there's material sales, they're going to meet that economic nexus threshold anyway, without the physical inventory through the marketplace facilitator. So it's important, obviously very important in Illinois for sure. It's important equally in Pennsylvania. You don't want to have physical presence asserted if you're under audit and you didn't know or weren't aware that your marketplace facilitator did in fact have inventory of yours located in the state. So it is good to have that in your back pocket.
And Jeff, not necessarily a new aspect of marketplace facilitators, but just for the audience's benefit, the other or another nexus creating factor of these marketplace facilitators is related to those different economic nexus standards. So even selling through a marketplace facilitator like an Amazon, where they are responsible for collecting and remitting the sales tax, we do have to also factor in most states, the volume of sales activity and the number of transactions that run through that marketplace facilitator. Meaning if you're over the threshold just through your Amazon sales and you're also selling via your own website, Maybe you're only selling $10,000 on your own website, but you have potentially reached the economic nexus threshold through that marketplace facilitator. So just be aware of that. That's a factor in most states. Again, as Jeff mentioned before, there are some nuances from an economic nexus perspective going from state to state, but the vast majority, I'd say probably 40-ish of all of the states, are going to factor in the gross sales activity into that economic nexus measure for you. So just be aware of that. All right, so Liz, I think we've got the second polling question for the audience here.
All right, we'll go ahead and launch that. The second polling question is on the screen. What is your main channel of selling? So while we leave this open for the audience to respond, are there any questions that you're seeing that you'd like to address from the audience in the questions box?
Yeah, so we've got one here, and it's a pretty open-ended question. So I'll throw it out here to Jeff initially, because there's a lot of pathways and angles where this could go. But it's related to streamlined sales tax, and the question is essentially, how does streamlined sales tax work? We have a client based in Illinois, but they have economic nexus in Indiana. Indiana participates in the streamline. Could you explain what it is?
I'll give a brief summary, and to Brian's point, it's really not an area we participate in, to be quite honest with you. SSTP, the Streamlined Sales Tax Program, was initiated, I believe it was in the late 90s is when things started. Charles Collins, I think, was the first director of that program, and he was from the North Carolina Department of Revenue, and I knew him from my days at the department back then. But the idea and the concept was to simplify sales tax to a degree that would enable multi-state taxpayers to comply more easily and allow the jurisdictions to impose their authority for tax collection more effectively. It got a lot of momentum in the early years. In the early 2000s, there was quite a bit of noise around it. There ended up being, I think, a total of 24 states that are either participating members or they're observing members, one of the two. But most of those 24, I think, are participating members. And what they simply did was to try to framework in a sort of matrix format the primary categories of products and services that exist in the marketplace, and to give guidance in that matrix for each state as to whether or not those items were taxable or exempt. Along the way, they created some consolidated registration options, and I believe there might be some other filing options that are more preferential in that regard as well. There's some other pieces to the SSTP that have some pretty good effects for taxpayers. In regards to your specific question, I don't know that I've got anything that I can share that gives you any sense of clarity. What I can tell you is that in our world, we deal with companies that are operating all over the country, and both within and outside SSTP states. And what we found early on was that it was not easy, or really we couldn't do it efficiently, managing SSTP registered taxpayers and then registering the other clients in a regular fashion. Plus, a lot of our clients who were in SSTP states were in other states that were not SSTP states. So they had to have a bifurcated approach either way. And as a result, we just don't play a lot in that particular area. It was great intentions. It just never evolved. And it wouldn't surprise me if it kind of dwindles or goes away over time as a result of Wayfair. Wayfair kind of solved a lot of that problem that necessitated SSTP.
Yeah, I think we've seen, certain sales tax software companies that provide both the calculation of the tax due, as well as provide the filing service. And some of those, they're considered CSPs, so certified service providers that have both a calc and a filing option. And there are some advantages from a streamlined perspective in that I think in some of those scenarios, quite frankly, it's a free service in some of those CSP or with some of those CSPs in the SST states. However, there are very specific requirements that you have to meet in order to participate in that program in terms of you can't have employees, you can't have inventory. There's very specific guidelines as to whether you can participate or not. So hopefully that kind of addressed the SSTP question for you. And I think the next topic here is taxability.
Great. So we closed the polling question. The results to the polling question are up on the screen, and it looks like we have direct retail and e-commerce leading as the main channel of selling, but certainly representation across each of these categories. So we'll close the polling question and we're back to your slide.
Awesome. Thanks, Liz.
Thanks, Liz. Thanks, Brian. So taxability wise, I get a question fairly often from our clients, and the question being, how often should we evaluate taxability of our products? Or maybe they're instituting some sort of a manual tax calculation process where they have to manually input the rates into their database. So the question becomes, how frequently do we need to evaluate our rates and update our systems so that we're accurately taxing and taxing the right things? When it comes to taxability of products, I tend to convey to clients that an annual review of that should be satisfactory. Most of the states are going to change their laws, and I'll probably contradict myself because we see some different dates in this presentation today. But most of the time, changes are happening either on January 1st or on July 1st. It's either a calendar year or a fiscal year for states for changes to rates and taxability. That being said, we also have to recognize there's over 10,000 taxing jurisdictions in the U.S., meaning that there's a ton of local jurisdictions that have individual tax rates, some of those being those home rule jurisdictions that Brian spoke of earlier, the vast majority of them being state administered, but they still have some level of authority to change their rates. So I tend to talk to clients again about taxability, and I kind of frame it as a annual exercise to just do a quick review and make sure nothing major has changed, particularly as it relates to your primary revenue source. This particular Alabama, and specifically this particular scenario that I'm going to talk about, is something that's a little bit unique. It has to do with contractors. And when I say contractors, I'm referring to people that are improving real property, building contractors, essentially. It could include electrical contractors, plumbing contractors, and so on and so forth. But generally speaking, there's kind of two buckets that exist out there from state to state when it comes to contractors. First thing is contractors are generally considered the end user consumers of the materials they buy and the performance of the contract. So when a person contracts to build a building for a company or for a client, they're basically giving them a lump sum, and it includes materials and labor. All the materials that go into that particular building, sales tax is going to be charged or paid by that contractor or the subcontractors, as it may be. There are already in a number of states specific rules that address contracts with nonprofit or exempt entities. Not every state exempts nonprofits or other types of entities, but there's a good number of states that do provide sales tax exemptions to nonprofits. And what Alabama has decided to do, effective 1/1/24, is to extend the exempt status of an exempt entity, a nonprofit organization primarily. They're going to extend that exempt status to that contractor, so that when that contractor contracts or builds that facility, they'll be able to go out and acquire their tangible personal property and exempt it from tax, thus passing through a pretty significant savings on to the exempt entity. Now, they're not going to be able to just do it randomly. They are going to have to go through some qualification with the state before they can get permission to act in that way. That's not uncommon. There's some other states where the contractor has to execute some sort of form to be able to qualify for that exemption. But it is interesting to see that Alabama is kind of going down that path, again, expanding the benefit of a sales tax exempt entity to include contractors. Another recent change that is important for a lot of technology companies is in Kentucky. When we look at those companies who were drastically or significantly impacted by Wayfair, they fall into two categories. They're either e-commerce or they're technology companies. And technology companies were operating in this sort of cocoon of electronically distributed information, whether it be downloaded software or, in this case, software as a service. And they would operate from places like California, where SaaS and downloaded software are not taxable for sales tax purposes. And they were distributing those software products out throughout the country, generating revenue in a multitude of states. Well, now that Wayfair is in existence, a lot of those technology companies find themselves in the position of having to determine whether they have nexus and then determine whether they have a tax responsibility on their products and services. There are still a number of states that do not tax downloaded software, and there are even more states that don't tax SaaS. But I'd say that we're starting to get to the place where it's at least half of the states or more that are charging tax on SaaS, software as a service, and Kentucky has added to that list. So effective this year, January 1st, Kentucky now asserts tax on software as a service. That's probably the most negative one in the entire presentation in terms of going backwards in time, in terms of making it more difficult or making it more taxing, so to speak, on our taxpayers. The next category, Michigan. Michigan has effective in a random date, 4/26/23. Usually when there's a random date like that, it's usually related to a court case or some type of precedent-setting determination that was made, probably pursuant to an audit, or it could have been some specific lobbying effort. So it could coincide with the date of an event that's getting ready to take place in the state. That's usually the case. But in the state of Michigan, they've instituted exemptions for installation charges effective 4/26/23. So if a separately stated installation charge is on an invoice related to the sale of a taxable product, the installation charge would not be taxable. The last state we're going to talk about is Utah, and this is a little bit different. Those of us that are in the business of selling at retail and wholesale are accustomed to getting resale exemption certificates whenever we're selling to a reseller or wholesaler. Similarly, as I described in the Alabama scenario, there may be sales to an exempt entity for nonprofit use, or it could be a state or local government use. Those entities have to issue some type of an exemption form or certificate to the vendor to justify the exempt status of that transaction. What Utah is laying out is a mandatory update, which is essentially saying that those certificates that are more than 12 months old have to be updated. So they're only valid for a 12-month cycle. This is not an uncommon thing. The state of Florida, actually their resale exemption certificate expires every year on 12/31. So every registered vendor has to go into the portal in Florida and pull down their new certificate for the following year and issue it to their vendors. They have to do that every year. There are other states which have some sort of expirations around exemption certificates. I think Washington has a 5-year term on the validity of their exemption certificates. And there's other states that have different sort of expiration guidelines. The vast majority of the states, particularly if we're talking about resale exemption certificates, don't have any expiration. In other words, once I get an exemption certificate from my customer as a reseller, I can put that in the file and bank on it forever and a day. Utah has sort of closed that period of time down to 12 months. So it's just important to understand, and if you've got a lot of business in Utah, just make sure you're getting those updated certificates prospectively.
So Kim in the audience asked, what's the best resource for researching taxability? Certainly there's thousands of different statutes associated with each state. There are definitely tools that help you get to these answers. Some of it still requires some level of interpretation. Personally here at Tax Connects, we utilize Thomson Reuters Checkpoint product. I think Wolters Kluwer has a similar product. I don't know the name of it. You might know the name of it, Jeff. No, shaking of the head, no. But there are definitely tools that allow you to more quickly get to these answers. Some of those tools, especially Checkpoint, have some, we refer to them, I think they're called creative charts, where you can look up, for example, SaaS taxability for all states. Now, and it'll provide to you a chart of whether or not SaaS is taxable in each of those states. The problem that we often see, and this may sound a little bit odd, but it's really knowing what it is that you're selling to be able to apply those statutes correctly. Sometimes it's very, very clear that a company is selling software as a service. Other times, especially in this technology world, it's not always cut and dry as to what is actually being sold and what's being provided. And so you have a level of interpretation of what is it that we're selling. And once you determine, oh, it's an information service, or it's a software as a service, or it's a data processing service, once that determination of what it is made, then I think those tools can be very convenient and very helpful to identify what the taxability of those different types of offerings are from state to state. All right, so the next topic here are sales tax rates.
Yeah, so as I was describing taxability, maybe annually you take a look at it as in terms of what changes might have occurred. When you get into rates, they're more prone to change a little more frequently. And so I tend to give the guidance of every 6 months, try to take a look at your rates and update them if you're managing them in a manual fashion. And that's because not only can you have changes at the state level, but you can have changes at the local level that are state administered. Alabama, they are reducing, which is not a common practice, by the way. They're reducing their sales tax rate from 4% to 3% effective 9/1/23. Again, not really a quarter-end date, so it's kind of an unusual date. But most of the rates that we see change are happening on a quarterly basis, or the beginning of a quarter. So your January 1st, your April 1st, your July 1st, and so on. So Alabama, we've got a pretty significant change in the tax rate. That's a very rare occurrence. And in addition to that, they are reducing the rate of food, or they're reducing the tax rate on food to 2%, projected to be effective 9/1/2024, but it's predicated on some other factors, some other budgetary factors that have to be met before that rate goes into place. So it's not quite there yet, and we will have to wait and see as to whether or not it actually does take effect 9/1/2024. And we see South Dakota again. So Alabama and South Dakota get a lot of press in this presentation today, unusually so. But South Dakota, in addition to removing that 200 transaction threshold, which was a nice change, they're also doing a temporary reduction in their sales tax rate from 4.5 to 4.2%. Now, when we're talking about these rates in Alabama from 4 to 3, South Dakota from 4.5 to 4.2, we're only talking about the state level rates. In Alabama, you're going to have city, potentially county, and other district rates that could apply. In South Dakota, you could also have some other local jurisdiction rates that apply. So we're not communicating that these are the only rates, or the only rate, I should say, that applies to any sale of tangible personal property in those states. These are just the state level rates that are changing.
And it seems like, to your point with Alabama, I think it's one of the top 5 or top 10 in terms of the largest combined state and local tax rate.
The combined rate in Alabama can easily get to 10%. Yeah.
All right, so Liz, the third polling question, if you could pull that up for us, please.
That sounds good. Third polling question, how is your business currently managing compliance for our use? So let us know. Do you need some help? Are you handling this with technology, with an internal person, maybe only technology, all internally, or have you outsourced your compliance? We'll do this open, and responses are coming in quickly. I don't know if you'd like to take a question or comment on an audience question here.
Yeah, there is a pending question here, and I'm going to save it to the end because it fits in nicely to our last topic. But kind of talking about these tax rates in general, we see a couple of different helpful tools that I'll just describe here real quick. So there are ways to kind of get at all of these different sales tax rates. There's some online tools that are even free. I think sometimes they're limited in terms of the number of lookups you can do from a address or zip code perspective. We end up having quite a few clients that utilize Zip2Tax as a tax rate database, just providing the ability to look up tax rates and gain access to those state and local tax rates. All of these tax rates are also just by virtue of how the tax calculation engines work. So those sales tax calc engines, and not only have the taxability rules built into them, but they also have the tax rates built into them as well. So that's a couple of different ways to get to those sales tax rates for you. And Liz, I think you had shared the results there. I think we'll go ahead and segue into another Colorado issue that I think is also still good news.
Still good news, but aggravating nonetheless. So I don't know, a couple of years ago, I think this is when Colorado instituted what they refer to as a retail delivery fee. And what they were trying to do was to offset the cost to the infrastructure of having all of those delivery trucks, whether it's UPS, Amazon, whatever's delivering property across the roads and down the city streets. We just realized that there's just a lot more infrastructure need for those size of trucks, and the impact on the communities, the impact on the environment, as well as the infrastructure. So Colorado came up with this brilliant idea of a retail delivery fee. So on any shipment of tangible personal property where there was a delivery to the customer's address, there would be this, I think it was 27 cents per delivery that would be imposed on the invoice. The 27 cents was kind of a fixed number, and it didn't matter whether I shipped $1,000 worth of product or $10 worth of product. The same amount of money or the same fee would be applied to that invoice. As a result, all of the taxpayers that were in an e-commerce capacity found themselves woefully unprepared to apply this fee to their invoices. It didn't have sort of any real relevance to the products that are being sold as long as they were tangible personal property. This, in essence, any delivery of any product was going to have this fee associated with it. So it became a real onerous request or requirement of taxpayers, and a lot of our clients were miffed about it, didn't know how they were going to manage through it. Everybody was taking a different approach, trying to figure it out. So we have a little bit of relief here, and the relief being that effective July 1 of this year, the state is going to exercise a bright line test or a safe harbor rule, and basically say if your sales are $500,000 or less, you don't have to comply with this retail delivery fee, which is a huge relief to a lot of companies. If you're not impacted by it, great. Consider yourself lucky. If you have been impacted by it, you probably have found it to be a headache for yourself. They're also allowing for retailers to absorb the cost of that fee without having to reflect it on the invoice. It's an election that can be made, but again, the dollar amount was not the headache for most of our clients. It was, how do we manage it? How do we get it into our system? Because if we're issuing 1,000 invoices a day or 1,000 invoices a month, we don't have a manual process to add this fee to everyone that has a delivery. So it's just a real challenge for a lot of taxpayers. So there is some relief on the way. There is one or two other states that have now instituted something similar. So I hope this does not become a trend that's irreversible. But I think it's the impact it's having on the systems of e-commerce dealers to be able to qualify transactions and appropriately apply the fee is going to be a challenge. The last slide, just going to make reference to amnesty. I get a lot of questions sometimes from clients about where is there an amnesty program, or I would like to just follow the amnesty program or go through the amnesty program. Amnesty programs were probably a lot more popular going back a decade and further. But let me tell you what they really are about for the most part, at least from a sales tax perspective. They're really designed for the states to be able to clear their general ledgers. I know that's not actually what might be happening, but they've got receivables on the books, basically, from taxpayers who've been delinquent in the past. They've accumulated penalties and interest, maybe some tax, and they just haven't cleared their bills. They haven't paid them. And they've got resources being deployed to try to collect or lien property and get the cash in the door. And so every once in a while, the legislature will kind of take a look at things and say, well, we need to really get the money coming in, and we need to get this stuff cleaned up. So let's introduce an amnesty program. And typically, that's what it's directed to, is clearing the books. It's getting those known tax liabilities off the record and paid. And what they'll do is they'll waive the penalties, sometimes even give interest relief in exchange for that taxpayer coming forward and paying the rest of the tax bill. Can be very attractive. However, the amnesty program generally aren't a good solution for a non-registered taxpayer. So if you're in the position of having established nexus at some point in the past and you are looking at potential risk and exposure under audit and you want to come forward and mitigate that exposure and that risk, the amnesty program is available to those taxpayers, but it customarily has different date sets that kind of prevent you from resolving all of your liability. And what I mean by that is there may be an amnesty program, let's just assume in Ohio. I'm going to talk about Ohio here in just a second. But let's say Ohio instituted in July of 2023 an amnesty program. That amnesty program is likely going to carry backwards in time, but only for the periods prior to the current calendar year. So it's going to skip the first half of 2023, oddly enough. So it's basically saying, look, if you've got some old receivables on the books of the state, we want to clean those up. But if you're a more recent delinquent taxpayer, you're not getting the benefit of the amnesty program. And so for purposes of mitigating tax liabilities for a non-registered taxpayer, the amnesty program tends to have that gap that just doesn't make it very attractive. So the alternative to that is the voluntary disclosure program. Those exist in virtually every state. So you are always able to avail yourself of the voluntary disclosure programs. Those are statutory or at least administratively provided in just about every state. When I say just about every state, it's every state. It's just that some states do it a little bit differently. But that's always available to you out there if you've got some prior period exposure and risk that needs to be mitigated. Amnesty programs probably aren't that attractive to you in those circumstances. Having said all of that, Ohio is the only state that has the potential for an amnesty program to come up. Now, it's been legislated or it's been authorized by the governor, but it's not yet been accepted. And until the budget director accepts it and institutes it, it doesn't exist. So it's kind of a false lead here that we've given you. But if you happen to be in a position where you've got some prior period of high exposure that you've already been assessed on, and you're having a hard time paying it, just keep your eyes open for a potential amnesty program that could give you some relief there.
All right, so Liz, I think we got the last polling question, and then we've got at least one question here from the audience, and we'll wrap up.
Excellent. All right, so fourth polling question's on the screen. Are you interested in learning more about Tax Connects? Go ahead and respond to that polling question, and we'll launch into Q&A.
All right, so Jeff, this first question, it ties nicely into the VDA discussion, and I'm going to ask it in two parts, but the first part is, can you describe what an XYZ letter is in relation to a VDA?
Yeah, so let's say you've been operating, selling tangible personal property into the state of Oklahoma. You had Nexus 5 years ago, maybe. You've been identified under audit, or maybe you're considering doing a voluntary disclosure with the state of Oklahoma. And you recognize that it's possible some of your customers may have self-accrued consumer's use tax on their purchases and paid that tax directly to the state of Oklahoma. Or some of your customers may have been audited by the state of Oklahoma and assessed use tax and already paid it under audit. An XYZ letter is essentially an affidavit that basically a customer can complete the form and basically just state that they've already paid the tax on these specific invoices in these specific amounts. So it's got to be a fairly detailed letter. It can be on your letterhead. It can be on the customer's letterhead. It needs to be on some formal document. It has to be signed. There needs to be provisioning of your registration number or the customer's registration number that proves they were registered and able to pay the tax. But it's not that there's this sort of XYZ form sitting out there that you can go find at any particular state level. It's just a generic term that's been applied and for the most part accepted across all states. I don't even know where XYZ letter originated. It's just an arbitrary sort of name for it, but it's essentially an affidavit proving tax was already paid.
And the second part to that question is, if you've got 6 or 7 years of exposure and you issue that XYZ letter to a customer that you have 6 to 7 years of taxable transactions to, are you asking them to sign off on 6 to 7 years worth of transactions, or are you going to try to limit it to what the look back period is in that state, thinking the client may be more apt to give you less information rather than opening it up for the full 6 to 7 years?
Yeah, there's two parts to that question. There's a strategy question there, because you can ask a customer to give you this affidavit, this XYZ letter, and they can just decline. They're not obligated to do it. So I think there is sort of a relevance to that part of that question that says, maybe I don't go back 6 or 7 years, even though I may have that level of exposure, because I can't practically expect that client to go back and validate something that's already older than the general statute of limitations, which usually is about 36 to 48 months. So depending on your customer relationship and the circumstances, and certainly the materiality level, you may take a strategy that says, let me just go after the last 2 years or last 3 years worth of confirmation. From a legality perspective, there's no real limit on how far you can go back. And when I say that, I don't believe that there is any state that has a published sort of acceptance to any of this. This is sort of a general, just a process protocol that seems to have gained pretty wide acceptance. So you can't really necessarily rely that this phantom sort of name of an XYZ letter is a legislated type activity. It's just something that's commonly accepted and agreed upon under audit. I don't want to call it a courtesy because I think it's relevant, but in any case, yeah, you could go back longer, or you could decide strategically it might be best to just keep it short term.
All right, Liz, I'm going to flip it back to you for final wrap up here, and we appreciate the audience's questions and participation. Thank you.
Yeah, wonderful. Thank you both so much for a wonderful presentation, really helpful and filled with a lot of great timely updates and good background. And I know the course audience really appreciates you taking the time to respond to the questions too. If there are any questions that anyone wants to follow up on more, you will receive Brian's email address in the follow-up email. So you can keep in touch with the Tax Connects team. There's also going to be a Nexus guide link. So if you want to access that, then you'll be able to access some more additional resources from the Tax Connects team. For the purposes of today's webinar, when you close the GoToWebinar control panel, a survey will pop up on your screen. We always appreciate your feedback. You can access your CPE certificate from your Incourse dashboard. The program recording will be uploaded this evening. The handouts are already there. So we hope that you'll join us. Tax Connects will join us again on October 19th. So mark your calendars for that date. We hope you can come, invite a colleague. We'll look forward to having all of you back with us again very soon. Until then, enjoy the back to school season. Stay healthy, take care, and we'll talk to you soon.
Thank you, everyone.